Hello and welcome to The Pitch, brought to you by Livewire Markets. My name's Eddie Orchard. So you think you knew about sustainable investing? Think again. David Wimborne, Senior Portfolio Manager at Impacts Asset Management, is here to take us through some of the exciting tailwinds in the space, bust a few myths, and also explain why avoiding hypergrowth companies is the key to building a sustainable portfolio. David, thanks so much for joining us today.
Thanks very much for having me.
What is one fact about sustainable investing that you think people don't talk to enough?
I think probably the key thing, which probably isn't talked about enough for people that aren't so familiar with sustainable investment, is the sheer breadth of the opportunity, which has expanded enormously over the 26 years that Impacts has focused on this opportunity set. And if I was to summarize the opportunity set at a high level, really there's two paths you can go down in terms of sustainable investment. The first is environmental sustainability, which is basically providing solutions to energy efficiency and resource efficiency type problems. The second is social sustainability, which is finding solutions to some of the big societal pressures, say things like aging populations, dietary change, which companies are involved in providing solutions there, or things like in the financial space, things like financial inclusion in emerging markets, providing banking services for people that previously didn't have them. Now, what I think is quite interesting is in that first leg of environmental sustainability, which is really sort of the bread and butter of Impacts, is where we started back in 1998. That opportunity encompasses essentially a very, very wide range of sort of sub-opportunities, and just at a very, very high level, it's starts off as energy efficiency, making existing processes much more energy efficient. Water infrastructure, which has very different dynamics, but these are companies that make the pumps, pipes, and valves that replace crumbling water infrastructure in many developed nations. Food, so the whole food value chain, circular economy, digital environment, and also clean and efficient transportation. And when you think about that sixth grouping, there's an enormous number of opportunities there. And similarly on social sustainability, really that sort of completes that opportunity set across all sectors of the global economy, where healthcare is a very important part of the investment universe for us. And in the Global Opportunities Fund, about 21% of the fund is healthcare. And so there's numerous really exciting sub-opportunities under each of those ones. So in summary, it's the sheer breadth of that opportunity and the number of exciting sort of paths you can go down to look for alpha generating opportunities.
And what are some of the myths that you hear a lot about in this space that you would love investors to just debunk and understand?
I think a couple. I think the first one would be that surely it's all about renewable energy, which isn't the case at all. We don't have any renewable energy exposure in global opportunities. And the second thing is that from our perspective, the reason why you invest in alignment with a more sustainable global economy is not through altruistic reasons, not through ethical considerations. It's because we believe you can generate better financial returns as a result of that. Now, the outcome of the whole process is generally you have a portfolio which is well aligned with the sustainable transition, and you invest in companies sort of hopefully addressing some of the big societal pressures we have. But I think it's just that point that you do this for pragmatic purposes, which is to generate better alpha.
And Impacts always talk about this idea of investing in high quality companies with sustainable tailwinds.
Yep.
How do you define quality?
For me, that boils down to consistency. So what I'm really interested in is identifying companies that have generated and have got proven track records of generating consistent margins, consistent returns over extended periods of time. They've been able to generate those margins and returns without lots of debt. So typically the holdings in the portfolio, very, very low, if any, debt within the portfolio. And a crucial one for me in terms of articulating quality investment is you need to do as much analysis on the supply side of the industry as the demand side. So we can talk all day about these wonderful demand trends, but what you can see is if you look back through academic research, you'll see that the ultimate determinants of how well a company does over the long term is not the demand picture of an industry, it's the supply. How many companies are making a similar product and how quickly will your margins get eroded over that time? And there's countless cases where the demand picture of an industry has been fantastic, but the supply side has changed. Cell phones are the perfect example. Nokia, dominated the mobile phone industry 20 years ago. 1.1 billion cell phones made every single year. Should have been a really good environment for Nokia. Of course it wasn't, because the supply side changed. Apple came along and launched the iPhone in 2006. So equal focus on the supply side of an industry as to demand, I think for me, is probably the key lesson for my career, I would say.
And when we caught up a few years ago, I remember you talking about that Impacts had benefited from avoiding what you called hyper-growth companies and instead focusing on more that sustainable quality. What are some of the characteristics or red flags of hypergrowth companies?
So as I mentioned, Global Opportunities has that quality investment focus. Now, you could argue maybe one of the drawbacks there is you miss out on the really early stage growth opportunities because we're investing in mature, established businesses which still can grow into the future, but they're already generating good margins, good free cash flow. And the point I was referring to a couple of years ago is that if you look at what led markets up to 2021, particularly in 2020 or 2021, was companies I would term to be hyper-growth tech companies. And these are a group of companies that really captured the imagination of investors, where you could see incredibly rapid top-line growth. And everyone assumed that growth would continue for an extended period of time. And probably the poster child examples there would be things like Peloton, Beyond Meat, Oatly, and those kind of companies. And maybe part of the reason why I was so skeptical about these companies is that I used to be a tech analyst, and I joined the industry just after the tech bubble burst. So I joined in the early 2000s, but I've done a lot of reading on the 1999 tech bubble, and one very clear pattern from that is that people extrapolated out fantastically high growth rates for a very long period of time, and they just weren't delivered on at all. Cisco, for example, was a poster child in that time, grew earnings at 40% revenue in 1999. By 2002, it's down to like 10, 12% or something like that. And the most amazing thing for those hyper-growth companies is they haven't kept up that hyper-growth which they benefited from during basically the COVID period for more than 2 years. And if you think back to what you saw in terms of maybe some of the sell-side analysis back then, they were assuming you'd see 20, 30, 40% revenue growth into almost perpetuity. So we never invested in those companies. On the flip side, I can say that a company that we've held in the portfolio, I'd say for about 8 years now, and has actually been the single best contributor to alpha over that time, is a US company called Cadence. And what Cadence do is they do software design tools, which sounds like it's hardware. It's not. It's basically software, and essentially it's the Lego instructions about how you would design a semiconductor chip. And why that's so interesting is basically as chips get smaller and smaller and smaller, at the same time as chips going into more and more different end markets, the demand for those chip design tools just gets higher and higher and higher. And what I love about this, and why it's like an archetypal Global Opportunities company, is that basically if you look at their return and revenue profile over time, it's incredibly consistent. When you think of the ebbs and flows of the tech industry over time, their revenue, returns, margins, very, very consistent. Now, why is that? It's because basically they are geared into the R&D efforts of the semiconductor industry. So whereas chip sales might go up and down like this, the big chip design companies will never really cut back on R&D because that's their way of ensuring relevance in the next tech cycle. And so what I love about Cadence is it's a way to capture digitalization with much less volatility. And for me, that's just a perfect example of a go company, basically.
Well, thank you very much for your time, David. That was a really fascinating chat.
Fantastic. Well, thank you for having me.
And if you enjoyed that, feel free to give the video a like and subscribe to our YouTube channel where we're adding fresh content every week.